You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Crete.
Etienne Crete here, Forex trader and founder of Desire to Trade. Welcome to episode 72, a special all-day edition of the Desire to Trade podcast. For the second episode of the all-day edition of the podcast, I'm sitting down once again with Chris Claflin. Chris has been in episode 48 of the podcast. And the reason why I liked to interview that guest so much in the first time was because of his story. Chris dropped out of school to become a full-time trader, and that took a lot of work. But he made it. And he shared a really great piece of advice through the quote of Ed Seykota, win or lose, everybody gets what they want out of the market. And the more you get in trading, the more you figure out that this is in fact really, really true. So in this episode, we dived a little bit more into how to trade multiple markets. Because Chris used to trade only futures, and he decided to jump to Forex recently. So we cover a lot of that in the podcast. We also talk about the specific routines Chris has, as well as his 5 keys to successful trading. So I'll leave you with this interview with Chris Claflin, and I'll come back at the end with the takeaways. Alright, what's up guys? So today I'm sitting down with Chris Claflin. Chris has been on the podcast before. I don't know which episode it is, so I'll have to go back after. But what's up, Chris? What's going on these days?
Not much, just watching some interesting activity out of some currency pairs, and then just trying to piggyback off of this Trump madness, the melt up that we've had in stocks. There's been a lot of movement there. So really lately, I've just been watching the markets, trading, and I've got a course that I've been putting together over the course of the last year, and so I'm working with traders and mentoring and stuff, and so that's been the bulk of what's been on my plate lately.
Nice. And just to give a bit of background for the people who are joining us only for this episode. So the last episode, I decided to do something special for Christmas time, so for the holidays, which is to bring back a few guests of the last year, the guests that I like to have in the podcast, the guests that made an impact. And I wanted to bring them back to share a little bit what they've been doing, and so they can share their best lesson on the podcast. So since the interview we had together, I think you've been doing a lot of stuff, probably more than you think even. And you've been transitioning, or I would say moving a little bit to Forex, right? You were trading futures, now you're to Forex a little bit. So how is that going on for you?
Yeah, well, it's good. I mean, I still consider myself a futures trader. That's my preferred instrument to trade. But, what got really frustrating is that, as I started this mentorship course, this trading course, which is really designed to take brand new traders from 0 to 60 or help experienced traders improve their profitability and really tighten things up. A lot of those guys are trading Forex, so I was forced to look into the pairs that these guys are trading. And it was interesting because, I'm focused primarily on the bond markets, the equity markets, and the energy markets as a futures trader. And a lot of those markets kind of traded into this choppy sideways holding pattern, prior to the elections. Mm-hmm. And not a whole lot was going on. And, I would see these, almost obvious. I mean, it was just the charts were screaming, buy or sell, on the dollar yen, or the Aussie dollar had formed into this, you and I talked about it before we started the interview, formed this monstrous bearish, wedge formation on a weekly chart. And, the more I was looking into some of these pairs for the sake of my students, the more that I realized, some of these periods during the year where I'm forced to kind of sit on the sidelines or trade small because the markets that I'm involved with aren't as obvious. I'm letting all these other obvious opportunities kind of slide by. So it's been an interesting thing to get more involved with Forex because it's a little bit more volatile. I feel like there's a significant more amount of risk when you're dealing with currencies, that are dependent on what a central banker is going to say. because if they say the right things or the wrong things, you can have these pairs move a tremendous, tremendous amount in the blink of an eye. You don't get that so much when you're talking about stocks or, certain commodities, but it's been awesome. And it has kind of opened windows for more opportunities. So and really it's not that different. So I would say it's just been, really nice to broaden the opportunities, especially when, equities or some of the energy futures are kind of dead in the water, which has been happening a lot lately.
Mm-hmm. But one thing I want people to understand is that you don't go there like blindly just looking at any chart and trading, right? You kind of have a plan from the start on what you like to trade.
Absolutely, yeah. And that's true for anything, Forex or futures, stocks or options. You have to understand what's happening on the bigger picture. And I think that's the biggest difference I think that's the biggest thing in Forex is you really need to be paying attention to what's happening on time frames way above where you might be trading. So I don't care if you're an intraday trader, and this is true for everything. I mean, it's true if you're trading oil, it's true if you're trading equities, but I've noticed that it is especially true in Forex. Even if you're an intraday scalper, you better be darn well aware of what's happening on the weekly time frame and even the monthly time frame. Like you gotta know what's going on, because if you don't, you put yourself at a big disadvantage. You risk jumping into a short-term counter trend move, thinking that the trend is reversing when really it's just a pullback. And if you're not paying attention, it can be easy to get sucked into one of these trends continuing lower and you're on the wrong side of it, or continuing higher and you're on the wrong side of it. So yeah, you got to have a plan. Absolutely.
Yeah, I think that aspect of time frame, you have to be careful, because some people are going to want to watch too much and wait for like everything to align perfectly, and they're never going to take a trade like in 2 months if they have to. And that might not be the best way sometimes. So I think you have to be careful, but it's definitely true that you have to pay attention to different time frames for sure.
Absolutely. Yeah.
So tell us a little bit. I know you have something you talked about in the first episode we did about the 4 principles of profitable trading. This is something that you've been putting out and that you've been working on, I think. So tell us what those 4 principles are a little bit.
Well, yeah. Okay. So, when I first started out trading, I really knew nothing about anything. And I think a lot of traders start out that way. And so every trader that comes through my course, I kind of try to pound these 4 principles of profitable trading into their head. And really, these 4 principles, if you stick to them and live by them and apply them to every single trade you take, it actually becomes very difficult to blow up your account. We all know traders who have blown up accounts. I've done it before, early on when I was first starting out, when you're just buying and selling stuff and you don't really have a plan, that's absolutely going to happen to you. And it even happens to traders that have been in the business for a while, because you just kind of get sloppy, you lose track of what it is you're supposed to be doing. And a lot of traders approach the market without a plan or a method. And these 4 principles really, they'll protect you from making a lot of the big mistakes. So the first core principle of profitable trading is, the cliche, which is cut losses early. So important. And, if you want, we can go deeper into each one of these, throughout the episode. It's really up to you. But the first one is cut losses early. The second core principle of profitable trading is to never fight the trend. You always want to align yourself with what the market's doing, because the market's bigger than you are. The third core principle of profitable trading is do not overtrade. And the fourth and final core principle of profitable trading is to always trade with a favorable asymmetrical risk-reward ratio. And what that means is if you're risking $1, you better be making at least 2 if that trade goes the way that you think it will. At least, if you're trading with a 1-to-3 or 1-to-5 asymmetrical risk-reward ratio, that means that your win rate can be way lower than 50%, and you're still going to make money, and if you've got a 30% or even 20% win rate, if you're doing this, you can still come out ahead. Now, that's a pretty lousy win rate. I know a lot of traders and myself, when things are going well and the markets are obvious, you can be hanging out around 70 to 80%, win rates. I mean, that fluctuates, obviously the market turns and you hit these drawdown periods where it seems like nothing works. But, especially when you're in those sweet spots where you're hitting, 60 to 80% of your trades and they're winning, if you're applying this principle, you're going to make a lot more money when you're doing well. And when things go poorly, you're definitely not going to lose as much, and you still might be able to scrape out some profits here and there. So those are the four principles that every trader needs to live and die by. And I came to this conclusion after years and years and years of studying the biggest players in the business. Guys like Bruce Kovner and Paul Tudor Jones, Ed Seykota, legends like Michael Marcus and Richard Dennis. All these guys do that. That's the way they do it. That's how they've done what they've done. Mm-hmm. And it's just a matter of sticking to your guns and doing that all the time.
And I think the last one is definitely self-explaining, and it's probably the biggest one. But I think some people might have a problem with the first principle, which is the one about cutting your losses short.
Yeah.
I find that people sometimes want to cut their losses way too short, like way too early. And they end up getting out of trades like before they even get in some profit, while they should be in the trade longer sometimes. So is there like a rule, or is there something you put in place to make sure that people don't quit too early?
Yeah, well, cut losses early really comes down to how you're managing your risk. And, there's a lot of pieces to this, because you've got to go to what's in your risk model, what's in your trading plan. And, those are separate from these four core principles. But at the end of the day, cutting losses early, if you're getting into a trade, you really need to be looking at what the market's telling you. You need to be looking at the charts. If you're getting long something, you need to be looking at the most recent heavily bid up demand levels. And so if you're going to get long a market, you have to look at the market logically, and rather than just saying, okay, I'm getting into this trade with 20% of my account and I don't want to risk more than 1% of my account. So I'm going to put my stop at X level, of pips away from where I'm getting in. That's a really inefficient way to approach the market, because you might be just, that might be nothing. The market needs to breathe. So really the way to approach the market is you need to look at the charts and see what they're telling you. Where's the most logical place that you can put your stop, where the market absolutely should not go if you're right? And if that's your stop, then you use that point to adjust your position size. If it's just a couple pips away, then yeah, you can trade a little bigger. But if you've got a stop that is quite a distance away from where you're getting in, you've got two choices. You've either got to not take the trade or trade very small. Because, you're absolutely right. When we pick arbitrary stops, it forces you out of trades that would have maybe otherwise gone your way. So you need to pick points in the market where, if the market goes there, the trend is obviously reversing, and you're wrong on your position. And a lot of traders have a hard time with that because they want to trade big. And and if you're trading too big, your stop is not going to go at the logical price point dictated by the market. It's going to go at your maximum pain threshold in terms of dollars and cents in your account. And that's a really, that puts you at the mercy of the market, and you turn into a gambler rather than a trader.
Sure. Or the other thing I see a lot is people who, as soon as they have a small profit and then price comes back toward their entry, they want to exit straight away. They don't want to have any loss. So yes. I think that's a big problem too, where people don't want to accept the fact that the price sometimes comes back. And that's part of the market, right? You cannot do anything. But people want to get out as soon as possible.
And there's one of the great traders of all time who is good friends with Richard Dennis is a guy named William Eckhart. And I was actually telling my students this morning is that he has a great quote. And he said that, I believe it goes something like, amateur traders go broke by taking large losses. Professional traders go broke by taking small profits. And that's exactly along the lines of what you said. I see so many guys on social media that will post these posts of money that they've made, and they say, you can't go broke taking profits. Well, yes, you absolutely can. Mm-hmm. And it goes back to what you're alluding to, because if you are allowing the market to fake you out, and you take a trade and you're up 1,000, then you're up 3, then you're up 5, and the market comes back to, now you're only up 4, now you're only up 3, now you're up 2.5, and you freak out and you get out of this thing. But then what happens if the market just skyrockets and, oh my gosh, I would have been up 25K on this trade? You're giving up profits and you're not allowing them to run. So you have to be able to do that. And the other thing that you need to keep in mind is a trader's profitability. You have to think of your business along the terms of a casino. And a lot of traders, like you said, they feel uncomfortable taking losses, and it's an ego thing and it makes them feel icky. So they don't want to take the loss. So they take the profit off when it's small, so they have a profit that grows, the market starts to come back, they get scared, they take their profit off early and they're out of the trade and it does start to go their direction. And what I want to wish more traders understood is that, if you think about the way that a casino makes money, I mean, Etienne, would you rather, if you want to get rich, do you want to be a casino owner or a guy sitting at the blackjack table, and why?
Pretty clear, the casino, I guess.
What do you think? I want to know what your thoughts are.
Well, yeah, for sure. The casino. Yeah. Casino, you have an edge and over time you're going to make money. While the
over time, right?
Lose money over time.
Now, is that guy going to win sometimes though?
Yeah, for sure. Absolutely.
So you as the casino are going to lose.
Yeah, you're going to lose, a little bit, but over time you have an edge.
That's exactly true, and so too many traders are focused on what's happening right now. Like, what am I going to get on this one trade? And, the casino, when you think about the way a casino makes money, I mean, who could come up with a better money printing business model than a casino? I mean, over time, they've got an edge. And yeah, people come in, they win money every once in a while. But when somebody wins money, the casino doesn't say to themselves, I mean, what's wrong? Why do we lose money on this dude? It's going to happen all the time. But the casino knows that over the course of, 10,000 hands that are dealt over a night or whatever, they're going to come out on top because they've got an edge. They don't care about the fact that they're going to lose on a couple of these things. And that's what traders need to adopt in the way that they observe the markets and deal with losses. It's like you said, it is absolutely part of the business. And it's about being able to come out ahead over time because we have an edge. And we define that edge through those core principles of profitable trading, as well as our risk model and trading plan. If you can accept that, whether or not you've made, it doesn't matter if you were up $3,000 on this trade and now you're back to break even and about to get stopped out, because on the next 7 or 8 trades, if you allow those winners to run, this single trade is going to be insignificant. So yeah, there's a lot of psychological issues around cutting losses early, and a lot of traders do it wrong. But you got to do it right, and it's got to be based on logical price levels and what the market's saying.
Mm-hmm, for sure. And I think one of the topics you touched a little bit on previously is the fact that people want to go quickly, right? No one wants to trade for like a year before going live, or no one wants to trade for like 5 years in a smaller account before increasing their account, or no one wants to trade for, I don't know, a month or like 6 months before leaving their job. So people want to go really, really quickly in trading. And you're really a big proponent of taking your time and doing things like pretty much step by step, but in a intelligent way, right?
Yeah, you definitely have to be smart about it.
So what would you tell those people who want to go quickly and kind of become a millionaire tomorrow?
Well, there's a book that has nothing to do with trading and everything to do with trading that's called The Compound Effect by a guy named Darren Hardy. Have you read that?
Yeah, I love that book for sure.
That's a book you need to read if you want to know how to grow your account appropriately. And the entire premise of this book is that, when we talk about growth, oftentimes it happens at such a slow rate in the beginning that it's almost imperceptible. And trading is a business of compounded returns, compounded percentages, right? So, and people have a hard time with that because, if you double your account, that's a big deal, right? If you've got $1 million account and you double that, in a month, you made $1 million in a month. Who else is doing that? That's a lot of money. Mm-hmm. And, you're patting yourself on the back. But if a trader's got $1,000 account and doubles it in a month, it's like, are you kidding me? Like, I can't live off of this. And, a lot of traders don't look at it for what it actually is. That's a massive, massive accomplishment, assuming you've doubled that account while observing proper risk management, and dealing with the market in an appropriate and manageable way. And so what people need to remember is, like, when it comes to trading, especially if you're starting out with a small account, especially in Forex where they give you these, minimum account levels of $50 and $100, you got to realize you're not going to be a millionaire for a very long time, because that is going to be a very, very beastly battle to grow that. I mean, you've got to double that time after time after time and keep reinvesting the money. But, what people don't realize is that growth is something that in all areas of life at the beginning stage happens almost imperceptibly. I mean, you can't even see it. Think about how long it takes a baby to develop in the womb from just a couple cells. I mean, for weeks, after a woman gets pregnant, she doesn't even know. And then once she knows, it's like, how many months do you have to wait until you see the bump and feel the baby? The same is true if you're overweight and you try to lose weight. I mean, when you go on the diet and start exercising, you're not going to see results for maybe weeks, and even then it's going to be just a couple pounds. But then once you start to build momentum and compound the results of what you're doing every single day, proper diet, proper exercise, or this baby growing, or whatever it is, even if it's just learning or building muscle, whatever it is you're trying to do, or building your trading account, you hit a point where you start to notice the returns. And then you hit a point where the returns seem to come more and more easily. And most traders, when it comes to trading, are not patient enough to let that time come. So they go through blown up account, and they never hit that sweet spot where they've reached a level of growth that has come from consistency and process day after day. Most traders never hit that point where, they're seeing the growth and they know it's coming from sound practices. They've developed good habits. And so from the point where they start to notice results to the point where they get to results where they're ready to quit their job or buy their dream house or whatever it is that they're trying to do with their trading, for traders that do it right, that point comes very smoothly. They don't have to change their behavior. It happens naturally. But most traders don't get to that level because they try to push things just way too hard. They're trading too large. They're over trading. Core principle number 3. They're trading too large. They're trading too frequently. They are, trying to get out of the market without losses. So they're not cutting losses appropriately. It causes all sorts of problems. And so traders, I don't know if that was a clear answer, but growth, you got to realize, especially if you're starting with a small account, you have to pay attention to what you're doing relative to the sized account that you've got. So if you've got a $100 account and you just made $30, that's awesome. You can't live off of that. Mm-hmm. But percentage wise, assuming you approach the market appropriately, that's a big deal. That's great. Keep doing what you're doing. If you've got a $100,000 account and you made a $30,000 return, 30% is not bad. And so you got to look at things in terms of your account value. And if what you're bringing in is just not significant to you in terms of dollars and cents, well, guess what? I mean, your account's just too small and you either have to fund it more if you feel that you're at a skill level where that's appropriate to do, or you just got to wait and grow it and continue to build your skills until you're at that point where you can smoothly transition into that phase where momentum is building and you're starting to see what you want.
But even then, you say making $30,000 of a $100,000 account. I think that's totally fine, but people are going to want to make this like in a week, right? Or like in a day. So is it even realistic to expect 100% in a month, for example?
Well, I mean, that gets into this other problem that traders get into, which is trying to calculate how many pips or ticks or dollars they can make in a day.
Yeah, exactly.
And 100% months, I mean, that's doable. Sometimes the market just throws you so many opportunities that like you can be a complete imbecile and still double your account. I mean, I've had months where I've been up 100-200%, but they don't happen very often, And so what you can't allow to have happen is have one of those months or one of those days where, you make 10 grand, 20 grand and expect for that to happen the next day, because the market doesn't distribute profits linearly. And, a couple times a year, there might be, 2 or 3 opportunities to double or triple, maybe even quadruple your account without, overextending yourself on the risk side. But you really have to be able to, you have to spot those on time. You have to get in on time. If you're fortunate enough to be in there, at a good price level and you trade everything perfectly and double and triple your account, that's fine. That doesn't necessarily mean you are throwing caution to the wind, because if the market is on a crazy run like we've seen in equities and the dollar since the elections in the US, I mean, geez, you could be sized relatively small and have made a huge chunk on some of these moves that we've had in the markets, assuming you're on the right side of it. And that doesn't mean that you're pushing your account too hard, but if you try to go into December and get those same types of results, not only are you not going to get them, but chances are that in order to try to force it, you're going to be trading way too big. So, traders have to realize that the market's bigger than you, and it doesn't care how badly you want to double your account. If the market gives you opportunity and you can do it without risking a tremendous amount of if you can do it with a reasonable amount of risk, then great. But if the market doesn't give you the opportunity, you better be trading small and accepting the fact that, made 8% this month, that's fine because there was just no opportunity. 8%, Etienne, could be a great month. If there's just no opportunity, that could be a really big month. If everybody else only made 1 or 2% or is down 5 or 6% and you're up 8%, that's awesome, But people don't like that because, a lot of us have been conditioned by school and stuff to, raise our hand and say, is this material going to be on the test? Teacher says yes, you study that material, you get the result. The market is not that way. We get what it gives us, and when it doesn't give anything, you just got to live with it.
And I think trading by default is like the way to get rich, right? It's like the main way that you see everywhere to get rich quickly, right? So people want to, they expect that to get rich quickly.
Well, it's true because there's a lot of guys doing it. I know a guy who started with $3,000 and in 3.5 months, he was up to $125K. This was at the beginning of the year. That's serious money in a very short amount of time off of a very small amount of money. Mm-hmm. But guess what? He's not in the business anymore. He lost all of it because, the way that he ran that up was putting 100% of his net worth into every single trade. And he just happened to be on the right side of the market for the first little bit. And then, and I told him, I was like, look, you gotta start looking at the markets differently. You got to trade smaller. It's like, yeah, whatever. And he's not a trader anymore.
Yeah, that happens a lot for sure. And I think that's the problem. People expect that they can. So yeah, they can make a big return, but can they make it consistently, every month? No. So how do you want to trade full time with that? It's impossible.
Right.
For sure. So that's for sure good stuff people have to apply.
And think about this. One more point about trading full time. Think about the big number, $1 million. If you've got $1 million, that doesn't make you wealthy if you're a trader because $1 million is your working capital. What happens if you have a 10 or 15, 20% hit, and you still have to pay yourself out of the market? Once you hit $1 million, you're putting your account at risk if you decide you're going to live a $100,000 a year lifestyle. If you're pulling $100,000 out of the market every year because you're a millionaire now, well, you're putting yourself at a 10% handicap on your money right out the gate. So, even when you're dealing with big money, you have to be able to manage that and pay yourself a reasonable amount without, letting the air out of your account. You got to be able to live off of your account in a way that's reasonable. So that way, if you do hit a really nasty drawdown period or the markets are flat and there's no opportunity, you got to be able to weather that without worrying how you're going to make ends meet,
Mm-hmm. And that's a big point though, because people think that they can just start to trade with any amount of money and then just replicate the same result every month or every year.
Yeah.
But it's not really the case. Yeah. So did you find a solution to that, or what do you do to make sure that you stay consistent with trading?
I guess it really comes down to process. If you follow good process, I've found that you can kind of have a general idea of what you're going to make every month within a ballpark. There's always going to be the month where you lose money or you don't make anywhere close to what your averages are. But, after you go long enough following a sound process and you approach the market the same way every day, every trade, you start to notice patterns, and it's really just like a business, or just like the casino. Every once in a while, the casino is going to have a statistical outlier month where all their gamblers lose all their money and they have a really big month. Every once in a while, they're going to have the opposite, where they have a month where everybody seems to be on a hot hand and they kind of drain the bank account a little bit more than normal. But, same is true with business. Every once in a while, business has a crazy month and you make a lot of sales and it was just like way more than you normally do, or the opposite. Nobody wants to buy your stuff. But, all the big companies, every casino that's out there, and most traders that are following a sound process and they've got consistency in their approach know roughly what they're going to be doing, month to month, assuming that they're following, a sound risk model. They're approaching the market the same way every single day, because what doing that does is, if you're approaching the market the same way every day and tracking data from every trade that you're placing, you can then go back and look at that data when the markets, when you start to not make as much money, and that data is going to tell you something about the market rather than yourself. If you're consistent about the way that you approach the market, when you start to lose money, that says something about a changing market, not that you're losing your edge, And if you go back and look at your data just to verify, you'll be able to see whether or not it's you or the market that's out of sync. And if it's the market, well, there's things that we can do as traders to deal with, the fact that we might be entering a drawdown period where the market's trading sideways, or we've got a lot of volatility and it presents more risk. We can reduce our size, reduce our interactions with the market until it tips its hand and becomes a little bit more obvious. And, I would assume that traders have a little bit more ability to roll with the punches in terms of changing conditions than, a business might, or a casino, using those two as examples. So I actually think there's an edge there if you're tracking your trades and if you understand what your process is and how to deal with a changing market.
Mm-hmm. Big stuff. And what is the number one lesson you got in trading, and from whom was that lesson from?
That's a good question. Okay, yeah. So I think the number one lesson that I got is that you can't necessarily trade your bias. You must trade the market. I have a friend who had been doing this for a lot longer than I had, and he's an older gentleman, and he and I both agreed on the idea that the Federal Reserve's propping up of the market and printing money to try to, help the economy, both here in the US and worldwide, recover from the recession in 2008. He and I both agreed that that was bad news for the dollar, bad news for stocks in general, that it was all going to end very badly. And it was interesting because this guy was brilliant at picking, tops and bottoms, and which, I don't condone, but he was really good at it. He's really good at spotting, structural formations in the market. He'd always email me or give me a call and say, hey, look, I'm looking at this and this market looks like it's about to do this or that. And he was always spot on with his analysis. But he wouldn't trade it because it didn't fit his bias. So all the time he'd call me up and tell me about stocks, and it was looking like these things were going to, the stock market's primed to go higher, all this stuff. Oh, it's so crazy. The Fed's behind this. And can you believe how ridiculous and stupid the market is, how stupid people are? So I would buy the market and the market would go up. And I'd talk to him and be like, hey, did you make a bunch of money? And he'd lost money because he tried shorting the market as it was going up because he believed that stocks were, levitating on nothing. And, you have to listen to the market no matter how irrational it may be. Like the technicals short term as a trader, like that's what you got to fall back on. Because I still believe that stocks are, gonna have a nasty drop eventually. But look at what we just had in the US. The Russell 2000 from bottom to top, the futures market, it's like a 20% range, which is crazy. Small caps have seen the largest percentage gain in such a short period of time that they haven't seen this type of rally for 20 years. Okay. And so it doesn't matter if you think we're in a bubble. If you're trying to short this market, you're losing. So that's the biggest lesson that I've learned from this gentleman who he and I kind of lost touch, and I don't know what he's up to right now. I can't imagine that he's still trading because if so, I can't imagine that he's been able to stay solvent this whole time because, you can't fight the trend. And this guy did, and he's a brilliant trader, brilliant at reading markets and predicting, anticipating where they're likely to go next. But he just couldn't break away from his personal bias. And he was always on the wrong side of these things.
And that's what people talk about when they say you don't have to predict the market to make money. You just have to trade what you see.
It's true.
Any other lesson you got, let's say, apart from this one, or anything you want to share with people?
Yeah, I would say also another big one is if you're brand new to the markets, you got to find somebody that does this and learn from them.
I love that one. Yeah, a big one.
Uh, yeah, you need a mentor, and you need a mentor that's willing to sit down and show you exactly what they're doing. Because you can learn a lot of conceptual stuff from books like The Market Secrets or Trend Following. Those are some of the two most widely known books on trading. But you're going to pay a price to learn how to trade. And that's either a price that there's really three prices you can pay. The price of time, which is figuring things out on your own, while paper trading, like you talked about, Etienne, if you've got the discipline to trade for a couple of years on paper, well, yeah, then you figure it out. You make all your newbie mistakes for free. And then once you've got a process down, you enter the market with real money. Most people don't have the patience to do that. So the next price that you can pay is to a mentor, and maybe you find somebody who's willing to take you under their wing and coach you for free, and that's awesome. But the price that you're going to pay to a mentor is far smaller than the price you will pay to the market, because the market is the toughest teacher there is, and the market will teach you the lesson after it gives you the test. And the price you've got to pay to the market is, for most traders, most really big traders I know of, myself included, my first year started out spectacularly, and then things got really nasty. You're talking about paying the market a price of six figures. And a lot of traders have paid even bigger price. There's a famous trader named Mark Cook who lost $500,000 on an account that was like worth 200,000. So he owed money. And it took him 7 years of working like two jobs and trading on his own to get out of that hole. Today, he's a multi-millionaire, but he didn't know what he was doing, wasn't paying attention, and he got smoked. Linda Bradford Rashke, one of the greatest short-term traders in the world today, she had a similar experience. It was, I think, an $85,000 loss on a $25,000 account. And, it was in her early days where she wasn't aware of the risks that she was taking in her positioning. And if you look at guys like Michael Marcus, that guy, he made $80 million off of a $30,000 account over the course of, a couple of years. And the thing is, that guy lost money nonstop for like 5 years straight until he met Ed Seykota and Bruce Kovner, who kind of, he was able to learn a little bit from them. And so you got to find somebody to learn from. And if you choose to have the market as your teacher, you better be willing to paper trade for a very long time, or you're going to pay the market price. And that's an expensive price to pay. And take it from me, because I paid that price and it was very painful.
I think that's very well explained. And I think when you look at example of traders in the past who had mentors, I think it makes a big difference for sure.
Yeah.
Yeah. And the one I always talk about is probably surrounding yourself with other traders. So not necessarily trying to figure out everything on your own and just staying at home trading and trying to get a lesson and everything, but trying to go out and meet traders. Is it something you do sometimes, or?
I don't. If there was a meet and greet where I could go and mingle with, the billionaires, the Carl Icahns and Ray Dalios and, the Bruce Kovners, I would. And I would keep my mouth shut. I wouldn't say anything around them, for fear of saying something that was obviously wrong. But, I try. I don't really love talking with other traders because, that are trading professionally, just because, I don't know what their angle is. I don't know what their process is. I don't know what their, I guess, you could call them trading values are. Because there's a lot of guys out there who make a lot of money doing crazy stuff. And I'm comfortable with a low risk approach that's based on, technicals and things that can be measured. And it's difficult because when you talk to a trader, you never know what they believe about the market, what their approach to the market is. So you really have to, I think that when you talk to other traders, you really have to have conviction in what you're doing already. And that's kind of a tough thing because, you have to ask yourself the question, okay, well, who do I learn from? How do I know what they're teaching is, is applicable and legitimate? But, it's interesting because a lot of guys out there are making money, and they've been making money for a while. And they've been making money for a while because they've been on the right side of a market that's been moving straight up for 7 years. What happens when that market turns? So the best way I've found to, kind of identify the people that are doing well all the biggest traders in the world tend to do the same things. Like if you really go and look back at, how Bruce Kovner makes his money versus Paul Tudor Jones versus Linda Bradford Rashke, they've all got differences, but at the core, and that's why I teach the 4 core principles of profitable trading. At their core, all those traders are doing those 4 things. So I guess, you could use those 4 principles as kind of your vetting tool to, if you talk to a trader for a couple of minutes, you could probably figure out whether or not they're following those. And if they are, then, they're probably a good guy to talk to. But you got to be careful because you never know what people are doing. And sometimes people make a lot of money doing stupid stuff. But eventually the luck runs out. And when markets turn, it weeds those people out. So
I think that's a good point. I think those 4 principles are really a good way to kind of screen out the good from the bad traders, right? Because it's just logical to me that you have to follow the trend or you have to trade what you see, right?
Yeah, absolutely. And those are even less important than cutting losses and not over trading, in my opinion, are the most important. And you can have guys that do okay without having any plan to cut their losses, and they are trading way too frequently, way too big. Like this gentleman I mentioned to you earlier who started out with the $3,000. Like this guy was trading way too often, way too big, no plan to cut his losses. And had I been, 6-7 years younger and met this guy, I would have thought he was a genius, and started doing what he was doing. And it doesn't work forever. So, and that's one of the, I guess that's the last thing I'll say along this topic, unless you have any other points you want to make on this topic. But this is counterintuitive, but it's so much better to go slow and right so that you hold on to your money and 12 months from now, you're still hitting brand new account highs than it is to go fast and go from $3,000 to $56,000 or whatever, or sorry, $156,000 or $125,000. I forget where this guy was. So much better to go slow and do that in 12 months than do it in 3. And then in another 3 months, be back to worse than where you were at to begin with and see all of it disappear. So, just make sure you're focusing on your process and protecting your capital. Because if you've got no capital to work with, you're not going to make any money. It doesn't matter what happens today. If you don't want to trade because things don't feel right, that's okay. You might take one more day to get to your $1 million status, but guess what? The markets are going to be there forever. But you're not going to be there forever if you can't keep the money that you make.
I think, that's powerful. So how can people find you?
I'm on Instagram at The Market Secrets. My personal Instagram is at Chris Claflin. And I also founded a website and company called The Market Secrets. So that's at themarketsecrets.com. And I have, kind of a contact page in there that people can reach out if you've got questions. The fastest way to get a hold of me is on Instagram. Probably, if you send me a direct message, and I'm always happy to answer people's questions if they're basic questions. Sometimes people ask questions that they think are basic that really are not, like what time frame should I be focusing on? I'm a brand new trader with a $500 account. There's not an easy answer to that, But I mean, if you have basic questions, I'm happy to answer them, and that's where you can find me.
Cool. And what kind of goal do you have for the future?
Oh, well, that's changed quite a bit since you and I talked. I still, still the goal is to be a millionaire before 30. And I think that, oh gosh, knock on wood, but I think that 2017 might be the year. And so I've got themarketsecrets.com, and that kind of started to grow faster than I anticipated. So that's one thing I'm looking at kind of growing and working with new traders and traders that are kind of struggling to find profitability. That's a really cool thing that I'm excited about. More importantly, though, what I'm really excited about has been kind of this new toe in the water in Forex. That's been really interesting and exciting as a trader. And then 2017, I'm going to be I'm launching a fintech company. So there's I can't talk too much about it, but we're going to be coming out with a mobile app designed for traders to be able to communicate and talk about up and coming opportunities in real time in a way that hasn't really been done before. So I can't really say too much more about that, but that one's actually the really exciting one for me because it solves a problem that nobody's been able to solve before. And if we can pull it off, it's going to be very powerful. So those are the things that I'm most excited for about the future, I would say.
Yeah, that sounds exciting. And 2 questions now. Why do you want to be a millionaire and why before 30?
I guess that's a great question. I don't know why. I guess here's the thing. The world is changing, and technology has made it so that the average person has so much more access to capital and access to opportunity than they ever have in the history of the world, ever. We live in an amazing, amazing time. But on the flip side, technology is destroying entire industries. There are, college is a broken system for trying to make a living. Like most degrees are becoming worth less and less. And the job market, to go find a job, is more difficult than it ever has been before. So the entrepreneurial opportunities are greater than they've ever been. I think that the steady 9-to-5 opportunities are less than they've ever been in the history of the world, which is an interesting thing. And so, if you look at that, and if you look at how much wealth is being created and how the cost of living is starting to go up and how the quality of jobs are starting to go down, I really think that $1 million is not what it used to be. And I think $1 million is kind of the base rung on the ladder that you have to get to live the same, upper middle class lifestyle that your parents did on way less. So, I think that if I'm not worth $1 million by the time I'm 30, I'm going to be behind the curve in terms of being able to provide a good life for, my kids and my wife and myself, and being able to do the things that I want to do. So I would say that that's the main reason why I need to do it before 30. And why $1 million? Because I think that's where the game starts, and if you don't realize that, that money is moving and there's a lot of opportunity out there, it's there for the people who want to take it. And that's my perception and my interpretation of the age that we're in and the opportunities that we have before us. And so for me personally, I think that if I'm not there by 30, I'm moving a little too slow, but I may be wrong, That's my opinion.
No, yeah, I totally agree with that. And just for people to know how many years they have left to reach that point.
I have 3 years to go.
It's pretty doable, I think. Pretty doable.
Yes. I think I can do it. I feel very confident, but I felt very confident at one other point in my life when I was a lot younger. And, I was a lot more foolish then as well. So like I said, knock on wood. But, I do think it is something that more people are able to do than they realize. I think that it's something that is more attainable than most people realize. Also because, like I said, I think that $1 million is not what it used to be. And people don't realize that. There's like a mental block because, oh my gosh, it's $1 million. But, $1 million is, today is, today, $1 million is maybe, 1960s, $100,000. Mm-hmm. Who knows? I haven't sat down and done the math, but that's kind of my feeling on it.
Yeah. And we have a question we always ask the guests at the end of the podcast, which is, you could give only one piece of advice for traders in one sentence. What would that one sentence be?
I would say that traders need to go slow, and every single decision and interaction you make with the market, you have to ask yourself logically, does what I'm doing make sense when I boil it down to numbers and risk and reward? Because when you start seeing the market as risks, reward, and money, it becomes a lot less confusing and you start making much better decisions.
Pretty powerful. I love that. So Chris Claflin, thanks so much for being on the podcast. It's been a pleasure to have you here for the holiday episode of the podcast. And I think people are getting a lot of value for sure.
Well, thank you so much, Etienne. It was, as always, a blast to talk to you. So thank you for having me.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desiretotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.